Hey, good day, everyone. Welcome to another Cambridge webcast. My name is Bert Salazar, and I'm going to be your host. This is going to be a short webcast, and this is going to be a webcast titled Why Taxes Will Have to Be Higher in the Future. You know, that's a question that I get asked often because, as all of you know, we in our firm, and primarily I in my firm, I do a lot of podcasts and seminars and webinars. We're always providing education because, you know, we feel very strongly that information without education always leads to failure. So whenever you go out and you start to Google stuff, all you're going to get is data and information. But if you don't know what to do with that information, chances are you're going to make financial mistakes not only now, but also for the rest of your life. So one of my major goals is to always provide each and every one of you with education that you can either take with you and implement, or if you need someone to help you implement, then you can always feel free to reach out to me, and I'll be more than happy to help you. Now, one of the questions that I get asked often is, you know, Bert, every time I see a seminar or a podcast or a webinar from you, you make it a point of talking about taxes. And you also make it a point of talking about, the fact that taxes are going to have to be much higher in the future than they are today. But where do you base that information? Where do you base that data that you're providing to all of us on an ongoing basis? So what I like to do is I want to take a few minutes to share not only my personal business experience and my years of experience in the industry, but also all the education that I have in the background in accounting and in finance and obviously in tax planning. Now, in our firm, we do three things and we do it very well. We do tax planning, we do insurance planning, and we do certain non-related investments like life settlements, non-registered investments, and so forth. We don't do investments in the stock market. We stay away from discussing any issues regarding stock market investments because they're not applicable to what we do every single day. Now, I'm going to share with you some numbers, and these numbers you can get yourself, but I'm just going to share a few numbers that I think are going to be very critical for all of you. Also, bear in mind that whenever I have a discussion with any of you, either on a one-on-one basis or through a video conference, we always talk about the three buckets, financial buckets, that the IRS controls on our behalf. And that is the taxable bucket, the tax-deferred bucket, and the tax-free bucket. The taxable bucket is everything that you put in that bucket that will be taxable to you, your family, and your business on an annual basis. That would include your mutual funds, your traditional mutual funds, your CDs, your money markets, your savings accounts, and so forth. And the reason why you know that everything is taxable in that bucket is that you're going to receive a 1099 every single year, which you have to report for tax purposes. The second bucket is the tax-deferred bucket, and that's where your 401ks, your IRAs, your SEPs, your pension plans, your KEOs, depending on whether you're working in the public sector or public sector, your 457, so your deferred compensation program falls into play. The money goes in pre-tax and money grows tax-deferred. Then when you pull the money out, it's tax-free. And then last but not least is your tax-free bucket, which includes your Roth IRAs, your Roth 401ks, your municipal bonds, and your 7702 plans, which are your cash value life insurance plan. The money to those plans go in on an after-tax basis. The money does grow tax-deferred, but the big difference is when you pull the money out, you pull it out tax-free. Now, obviously, over the next few weeks, we'll be going into each and every one of those buckets individually to share the good, the bad, and the ugly of each bucket and the benefits and the features and benefits that are so critical to maintain and to understand in order to maximize your tax-preferred income in retirement. So with that being said, I am going to go ahead and share my screen. So you can now see the screen that is put together by it's called the usdebtclock.org. And you can get this online. You can just log in and be able to see how the debt in this country is increasing every single second of every single minute, of every single hour, of every single day, of every single year of your life and my life. Now, there are a lot of numbers that you can see there, but obviously I'm just going to call your attention to some of the numbers that I think are going to be very critical for you to understand from a business perspective, as you start to figure out what your tax liability is going to be, not only this year, but next year, the next 5 years, but for the rest of your life. Take a look now. Obviously, anything that is red is bad. That means that's a debt, that's a deficit. Anything that is green is the income that is coming in to the U.S. government through sources of taxation and other revenues and so forth. Now, the first thing I want to call your attention to, take a look to the left-hand side of the screen, and you will see a big number that says U.S. national debt. Notice that that number is at $21 trillion, $21.7 trillion and counting. Eddie is getting very close to 22 trillion in debt. That is the national debt that we have in this country. Now, the debt per citizen, as you see adjacent to that, is 66,000, but the debt per taxpayer is 178,000. So the difference is what's the difference between the debt per citizen versus the debt per taxpayer? Well, approximately between 35 and 40% of Americans do not pay taxes. So therefore, there's a difference between dividing that almost 22 trillion by all the Americans that live in the United States versus taking the same 22 trillion and dividing that by the amount of taxpayers that live in the U.S. and that pay taxes. So that's why the number is so much greater. The other number I'd like for you to pay attention to is the number adjacent to the debt per taxpayer, which is a green number, and that's a federal tax revenue. Notice it's about $3.3 trillion. So that means that we are receiving on an annual basis approximately $3.3 trillion in revenue that's coming in to our government through the sources of taxation and so forth. Now, if you go back to the left-hand side, right below the national debt, see that we have the federal spending, the U.S. federal spending is at $4.1 trillion. So here's what this is telling you. We have $3.3 trillion coming in revenues, but we're spending 4.1. So we're actually spending 800 and some odd billion dollars more every single year than what we take in. Can you imagine if you live in a household where you're bringing in $10,000 a month, but you're spending $15,000 a month? Now, how long do you think you're going to be able to maintain that? So understanding the national debt, understanding the revenues that are coming in, also understanding the spending, the federal spending that we're putting out, and what the deficit in is, should give you the ability to understand what's going to happen in the future when it comes to taxes. Because the only way that the U.S. government can reduce the debt is by either reducing the liabilities, spending less, or maybe even growing the economy to a certain level. But obviously, there are questions along those lines. Can you maintain that growth once you commit to a given dollar of debt? That's going to be very, very hard to do. So at the end of the day, the only way that we're going to be able to reduce the debt is by reducing the liabilities that we have today. Now you wonder, what are some of the biggest liabilities? If you notice on the left-hand side, just go down a little bit more, and there's a section there that is the largest budget items that we have in this country. Notice that for Medicare and Medicaid is $1.1 trillion. For Social Security is $993 billion. Yes, the problem with Medicare is much, much greater than the problem that we have with Social Security and the Social Security funding today. We're spending about $673 billion in defense. We're also spending about $296 billion in income security. We're paying approximately $332 billion a year just to service a debt, and that's the interest that we pay on the national debt of $21.7 trillion. And then last but not least, federal pensions is costing us approximately $263 billion a year. So when you take a look at all these issues that I have just shared with you, and I haven't shared with you the biggest issue yet, but when you start to take a look at all these issues, the liabilities, the amount of debt, what it takes to service a debt, and then obviously the revenues that we're bringing in, things are not going to look very good for our country in the future. As a matter of fact, David Walker, who was the Comptroller General of the United States, and he quit in 2008. He was there for 10 years. He basically said that if taxes are not doubled in our country in the next several years, then obviously our country is going to go bankrupt. Now, I do want to bring you to the bottom, toward the very bottom of the screen that you see there. And you're going to see a number toward the middle at the bottom. It says U.S. unfunded liabilities, and it says $115 trillion. Now, the unfunded liability includes the unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the interest on the national debt. So that means that unfunded liabilities are promises that the U.S. government has made to Americans that we don't have the money to pay for today. So that means that the unfunded liability is sitting at $115 trillion. Yes, you heard me right, $115 trillion in counting every single second, and we don't have the money to be able to pay for today. Now, that brings obviously a lot of issues into consideration. For instance, for Social Security and Medicare, if we had in the Social Security coffers today, if we had $17 trillion earning Treasury rates, then we would have enough money to be able to pay our Social Security debt in the future. If you had 27 or 20, almost 28 trillion in the coffers today, earning Treasury rates to take care of Medicare, Medicare would be in good shape. The problem is that those numbers are not there. We are actually paying numbers that are no longer able to be paid because of all the liabilities that we have in our country today. When you take a look at Social Security, when it started in 1935, for every retiree, there were 42 people employed. It was a 42-to-1 ratio. Today, the ratio is 3-to-1. In the next few years, the ratio is going to go to 2-to-1. Now, back in 1935, retirement age was 65, but the average life expectancy was age 62. And if you were one of the lucky ones that actually made it to age 65, there was a probability you were going to live an extra 2 years in retirement. Today, the numbers are totally different. Most Americans are retiring. Most Americans are living at least to the age of 65. You can actually retire at the age of 62. And most Americans are retired at age 65 or at age 62 have a 23-year probability of taking money out of the Social Security coffers that is no longer there to be paid. So something drastically is going to have to happen in our country in order for us to be able to pay for the liabilities that we have today. So whenever I do tax planning for clients, my number one goal is to make certain that they can take control of their tax planning. And the only way to be able to do that is to have a clear balance between the taxable bucket, the tax deferred bucket, and the tax-free bucket. And most important, understand what their tax liability is going to look like in the future. Now, I do get calls from clients, and then whenever we do audits for our clients, we get, the feedback that, Bert, am I not going to be in a lower tax bracket when I retire? And my answer is always the same: only if you have been a financial failure for your entire life. Because what happens is, even if the tax rates do not go up in the future, there's a very high probability that all of those deductions and exemptions that you had while you were working are either going away or have already gone away. So for instance, your mortgage deduction. By the time you retire, your home is going to be either paid for, or you're only going to have a few years left. So the vast majority of the money that you're paying toward that is going toward principal as opposed to interest. So you're not going to have that deduction. Your kids may not be out of the home by the time that you retire. You hope so, but they may not be out of your home. But on the other hand, you can no longer take a deduction for them. If you're no longer working, you're no longer making contributions to your qualified plans, your IRAs, and your 401k, so you're not going to be able to take deduction for those plans as well. And then if you were making charitable contributions to a charity of your choice while you were working, something interesting happens when people retire. You start shifting from making dollar contributions to giving more of your time to the charity, but the IRS does not give you the ability to deduct time. So many of those deductions, exemptions, and credits that you are receiving while you're employed are not going to be eligible for you in retirement. Now, we have an 8-year window under the new tax law that started January 1 of 2018 through December 31st of 2025. We have an 8-year window in which to be able to maximize your tax preparedness and to make certain that you are ready for January 1st of 2026, because there's a very high probability that taxes are going to be much, much greater past December 31st of 2025 than we've seen in the past. So we have an 8-year window. Your standard deductions are greater today. Your tax brackets have been reduced. So you must start doing proper tax planning in order to start shifting assets from your taxable bucket and your tax deferred bucket to your tax-free bucket. Now, we do a lot of provisional income calculations for our clients, and I'm not going to get into that today, but only when you do provisional income calculations will you realize that there's a very high probability that if you take control of your tax liabilities today, you're always going to have full control of those liabilities in the future. And what is the best tax bracket to be in retirement? It is the 0% tax bracket. It's not the 10, it's not the 20, it's not the 40, it's nothing. It's the 0% tax bracket. Because if taxes double in the future, your 10 becomes 20, your 25 becomes 50. So I'd rather be at a 0% tax bracket than in any other tax bracket whatsoever. Now, in order for you to get to the 0% tax bracket, you have to do tax planning. You cannot just do tax preparation. So if you feel like you want some additional information in order to discuss your tax liability today and in the future, and what are some of the steps that you need to start taking in order to minimize that tax liability and maximize your retirement income, obviously feel free to reach out to me. You can go ahead and call me at area code 786-766-1042. You can also email me at Bert, B-E-R-T, at gablestaxgroup.com, and I'll be more than happy to schedule a 30-minute, no obligation, no cost video conference or conference call with you in order to discuss your specific situation either now or in retirement. And I always want to leave you with the idea that my number one goal is to kind of help all of you change the way that you see things, because when you change the way that you see things, the things that you see change. So again, thank you so very much. As you can see there, I am petrified as to what's going to happen in our country in the very near future from a taxable standpoint, but we do have the ability to take full control of everything that we do every day. Don't leave it to chance. take control of your tax liabilities, reduce them as much as we can, and we'll talk to you, and I'll talk to you very, very soon. Thank you and have a great day.